Hey, what's going on everybody? Alex here and welcome back to another video. And in this video, we're going to be reacting to Dave Ramsey, whether you love him or you hate him. And in this video, we're going to be talking about a caller who called into his radio show and asked him how much home can they afford. Now, as a mortgage loan officer, this is something that I speak to clients on every single day. And we're going to kind of attack this question from two sides. Number one, we're going to talk from a technical standpoint in terms of how much can someone actually qualify for with qualification. And number two, from more of an idealistic standpoint of where you just think you should keep your mortgage payment under depending on how much money you make. So before we dive into this video, do me a huge favor as my channel is new, turn that like button blue and comment down below what you think. What are your best practices when it comes to your mortgage payment? So let's just jump into it.
Kevin is in Texas. Hi, Kevin. Welcome to the Dave Ramsey Show.
Hey, Dave. Good to talk to you. Thanks for taking my call.
Sure. What's up?
My question is about buying a house. My wife and I are saving up for a down payment on a home. And I've been listening to you for a little while, but I'm pretty new. And I know we are debt-free. We have an emergency fund fully funded.
And that's great. If you guys follow Dave Ramsey, you hear the guy already saying, hey, we're saving up for a down payment. Now, you do not need a down payment to purchase a home. And this is my argument. If it takes you guys a year to save for a 3.5% or a 5% down payment, we're seeing rapid appreciation in today's market where you are missing out on opportunity costs, where yes, it is more expensive to get into a loan that is no money down, but by the time you save up that down payment, that same home could be, going for $20,000 to $60,000 more, depending on the situation. But I think this guy is already kind of starting off on the right foot. Obviously, you can tell he's listening to Dave Ramsey. Having an emergency put together, which is always a good idea, regardless of where you stand on the financial spectrum, from ultra conservative to ultra aggressive. But it's important for people to know that you don't always need a down payment, and sometimes saving for a down payment actually, could be costing you more in the long run.
My question is, we both currently work full time. And so how much house should I kind of look to buy based upon our incomes? And here's the deal. She's going to graduate school for a couple years, starting in the fall. She's going to get a counseling degree. And that'll mean our total income will drop for a little bit while she's going to school. We're going to pay for that in cash. But then she's going to make more money, most likely. Obviously, nothing's guaranteed.
And so this is something that happens sometimes where a couple comes in and they say, hey, you know what? We have two incomes at the moment, where we know eventually our income's going to get cut in half because my spouse is going to be going to school to better their career, which is great. Now, whenever the underwriter is reviewing a client's file, they're looking for stability of and consistency of income. So obviously this is something that we don't want to tell our underwriter that they have the intentions of going to school and quitting their job. But from a technical standpoint, in terms of qualification, you could use both of those incomes as long as those incomes are deemed stable and predictable, even though she is planning on going to school. Now, is it always a good idea? No, it just kind of depends on the client's comfortability and if, from a qualification standpoint, they can qualify with maybe just his income. But it's good that they're looking kind of into the future of like, hey, my wife is going to be going to school soon and we're losing some income. So that always kind of muddies the water, but at least they have the income now. And so in terms of getting qualified now, you should have no problem.
Later. And so my question is, should we buy a house according to that 25% rule that you have off of our current income, off of our income during those 2 years, which is when we'll buy the house where she's in school, or more along the lines of a conservative estimate of what we'll be making together after she graduates?
Okay, real quick. So we know if you listen to Dave Ramsey, I'm not a big Dave Ramsey fan, and some of the things that he talks about, I think some of the things he talks about is very good and fundamental for those who are trying to, being debt free and things like that. Like, I definitely think Dave Ramsey is good, but 25%, that is a pretty low payment in my opinion in comparison to your gross monthly income. For example, if you made $3,500 a month, in gross wages before taxes or deductions, which I'm assuming they're talking about gross, that is only an $875 payment. Now, if you have two borrowers, two people, so let's say $5,000 a month, 25%. That's $1,200. With down payment, that's only going to qualify you for 220,000 maybe, depending if there's HOAs and all that stuff. So, this just might not be feasible in some areas. If you're looking some areas like California and you're looking some areas at New York, you're not gonna find 20. If you're making this kind of money, you're not gonna find a house 25%. It's just not gonna happen.
Probably the middle of those three, which is probably where you are right now, right?
Yeah, she's about to stop working full-time and work part-time.
Yeah, and so where you are today.
Real quick thing. I'm sorry, I'm stopping it a lot. If a borrower is going from full-time to part-time, can't use the income. Now, if a borrower is going from part-time to full-time, that is more stable and predictable. But in her case, if they did not close on their mortgage before she went to part-time, they wouldn't be able to use her income anyways to qualify for the loan. And sometimes dividing and conquering, sometimes better anyways. Do the house under husband's name, maybe put auto loans under wife's name. They're right. Sometimes just dividing and conquering financially sometimes makes more sense as a couple. But that's an important distinction, because this question is kind of a loaded question. They're saying, do we go and use both of our incomes now and get a house that we want now? And so over the next 2 years, while she's going to school, either they're in a home, or based off what they're making now, or are they kind of making the decision based on what she's potentially going to be making, which is kind of like, it's hard to say. My say is definitely get into a house now while she's going to school, right? Appreciation and having a place to live in the meantime just totally makes sense.
If you took 25% of that, here's the point of the 25%. It's not magic. The point is, long-term, over the next 5 or 10 years, if you have a house payment that eats up all of your income, you have no money. That's how deep the 25% is, okay? Because you can get qualified for a loan that's 50% of your take-home pay.
Actually, correction, 50% of your gross pay. Yes, do we suggest going up to 50%? No, but that's 50% of gross before taxes or deductions. For a conventional loan, FHA loans allow you to go up to 56%. So, do we see a lot of people that do that? Yes. But yeah.
And you can't even breathe. You can get qualified for a loan that's 35% of your take-home pay easily. And then you have trouble funding your car replacement fund, your 401k, your kid's college fund, because you become increasingly house poor. Now, what you're describing is a temporary situation, not a permanent situation. So if someone calls me up and their house payment's 50% of their take-home pay because one of them just got laid off in the coronavirus, well, that's not what we're talking about. You would just hang on through that because you're going to get your pay back, and afterwards, and you're going to be okay in the house. So it's not a snapshot of a moment in time. It's a concept that over the scope of the next decade, it's going to be very hard for you to avoid debt and prosper if your house payment's eating up all of your income. That's really what it comes down to.
And I would agree with that, right? Like, obviously, we got to make more money than you spend, right? Your burn rate cannot be more than what you're making. And that's why my philosophy is you got to go and make money. Go and make money because it makes everything else easier. Now, just because you're making more money, does that mean you spend more money? Of course not. So I see what he's saying. It's kind of a blanket statement, right? He's not really answering the guy's question yet. Let's see if he gets there.
And so if you kind of said, okay, the low point of your income is while she's in grad school, the high point of your income is after she gets out, and the medium point is kind of where you are right now. All I did was just say, hey, maybe where you are right now is maybe a good measure of that. It'll be a little bit of a strain while she's in grad school, and then there'll be almost no strain later when she gets out, and you'll be able to do a whole bunch of other stuff, and you won't be house poor. If you did it based on the anticipated income, basically we're saying until she gets her new job and her career blossoms off the new job, off of grad school, until then, you're probably not going to make much progress financially because you're putting it all in a house payment.
And so in the situation where he's giving him these options to be, and he's kind of telling him to be conservative, and he's kind of laying it out, If she ends up going part-time, that's going to kind of limit how much they're going to be able to buy anyways if they're only using the husband. And so using the anticipated income is difficult because they can't use that for qualification regardless. Now, ideally, depending on where they live and what kind of homes are available, I mean, what would be really ideal is if they can go find a 2-unit duplex. They can actually buy a 2-unit duplex with an FHA loan and actually with no money down, if they don't have the down payment, right? Yes, your payment's going to be higher, but if they're renting out that other unit, that's going to hedge against that higher payment anyways. Therefore, their net payment after having a renter on the other unit is going to be less regardless, even if they had to stretch his qualification a little bit. And even if she didn't go part-time yet and they stretched both of their qualifications for the time being, with the caveat of having a renter in the other unit. Now, this is a very specific example, but I mean, in my opinion, that's what would be ideal. I mean, what's going to be better than getting her through grad school than having rents on the other unit, or even renting bedrooms, right? These are things that you could totally do. But one thing that you could essentially bank on is that appreciation over 3 years or 4 or whatever, how many long she's going to be in school. So, I mean, by the time that they get done with school, they could sell and then go buy another home, since now she has more income as well once she's nailed down a job, right? And so there's a couple ways to skin a cat here.
That makes sense?
Yeah, makes perfect sense.
So what period of time do you want to be house poor? Oh, and how old are you?
We're both 30.
And how many kids have you got?
0 kids.
No kids. Okay. Do you plan on having children?
Yes, we will have a couple kids.
Okay.
What
do you think the probability is you move?
Yeah.
Yeah. And so I wouldn't spend the next 5 years straining on a house payment based on the income target 5 years from now in order to own a house that I'm probably not going to live in after I have kids.
Yeah.
Why strain? It's just not, it's a temporary thing.
And so he's kind of telling them maybe to not buy the house and to not worry about it and not strain over that time period until they graduate and yada, yada, yada. But again, I think there's a big opportunity here to buy into the market where, again, there's opportunity cost. Yes, can values go down? Absolutely. But the demand, especially in real estate in all of the US, is so high right now where even if they got into a pinch and they needed to sell, I mean, they're going to have 15 to 17 offers on that house anyways, right? And so it's one of those things is a house doesn't always have to be a long-term plan. Now, is it the cheapest way to buy real estate and to not have it long-term? Not necessarily. It does get more expensive because every transaction, every time you buy and sell, there's cost to that. It's one of the most expensive assets to acquire due to just the costs that are associated with it. And so in this specific situation, although we don't always say, hey, you just keep moving around, keep buying and keep selling, keep buying, keep selling. That's not maybe ideal, but in this specific situation, they might be able to get into a smaller house now where, again, they're going to be somewhat limited on a qualification standpoint anyways if they're using just as income. And they can then turn that into a rental property in 2 or 3 years once they have more mobility and they want to start having kids and they want to go and buy a bigger house because now they have more income. So from a qualification standpoint, they're already going to have restraints anyways. And so it's like, I wouldn't even worry about the anticipated income. I would find something that's going to be a good move to live in for a couple of years. Maybe they can work on it while they're living there, put a little bit of sweat equity into it, and maybe they could even then sell it when she's done with school and make some money, or turn to a rental property and just go that way, right? I don't.
And so, all that, but the whole point of the whole discussion is, if too big a chunk of your income is going out the door in house payment, you can't do nothing else. You're house poor. So if you'll just guard against that, you'll make the right decision. Okay?
Right. And 25% is pretty conservative. So if I try to keep on track there, we'll be good, even if we end up having to strain a little bit more.
Exactly.
For those couple of years.
Exactly. The 25% is based on having done budgets for 30 years with people. And I'm saying where you are now is your projected income today. And based on that, we're going to do 25%. That gives you room for kids' college fund, car replacement, Christmas, insurance, start your 401k, maybe step 4, and that kind of stuff. If you get.
All right. So, I mean, okay advice. In my opinion, I think there's a reason why he gives that advice. I think it's really conservative. Again, so let's talk about the two sides. We've talked about qualification. Depending on the type of loan that they do, they can go up to 50 to 56% of their gross income. Now, the first question is who's going to be on the loan? They don't know, both need to be on the loan. And so they could, if they're just using Kevin's, who's the husband, then they're going to already have restraints on their qualification anyways, because they can only go up to 50% of his income. So for example, if his income is $4,000, I mean, they're not going to be able to go with their total debt to income ratio. That's their mortgage payment, their taxes, their insurance, that's everything in their payment, plus all the debts that he has in his name, which he says, I think he said he's debt free. So just his mortgage payment divided by his income, he's not gonna be able to go over 50% anyways, right? On the front ratio, which is just his payment divided by his income, you can't really go over 47%. So there's already gonna be restraints there from a qualification standpoint. I think that's the first step. More than the ideal route of like, oh, we got to be under 25%. Well, if it's just him, they might not qualify. There might not be anything in Texas where they're from that they can even buy with 50% of it or 25% of his income, let alone 50% just of his income. It just depends. So, now, from an idealistic standpoint, it depends on your risk, right? Now, these guys obviously listen to Dave Ramsey, so they probably are more risk adverse. And he said they have no debt, which is fantastic. But typically, that people don't have any debt, they're kind of more opposed of getting more debt, and they might be more, opposed to having a higher mortgage payment, even if they could then go rent bedrooms out or go rent a unit out if they got a duplex. Not everyone's really built to have that kind of debt. I mean, they just don't feel comfortable with it. And sometimes that's more important, even if it's not more of the financially smart decision, because, for example, if they can go rent out the other unit and even lower their net payment, and even though they stretch their qualifications at the point of buying the house, we know that their income is only going up, right? Now, I kind of disagree that, yes, to a point that if they have a higher payment and they have less money that they can spend on other things like savings or 401ks, then of course, like you're not going to necessarily get ahead. But people don't always take into consideration a house is kind of like a forced savings account. And now this might not be a most popular opinion, but again, you get principal buy down. So you're buying down that principal in the loan and you're getting an appreciation. So for example, if your home's going to appreciate at 3, 4, 5% year over year, and I mean, right now in our real estate market, we're saying 15 to 20%, which is, yes, is that not sustainable? Probably not, but that's a forced savings account. So if in 3 years from now, you can say, hey, our value of our home has in total appreciated, year over year at 20% over year. I mean, you're not going to get farther ahead putting that money in an index fund over that same period, right? Like, the real estate move might be actually just the best move for these guys anyways, regardless of what they want per se in terms of what they think they should qualify for. They just need to go and actually see how much they actually can get qualified for first, right? I know it's idealistic to talk to Dave Ramsey and say, hey, what do you think? But Dave doesn't know because no one knows what their income is. He didn't disclose what it is. We don't know exactly what their qualification is going to be, regardless of what the 25% mark is that Dave Ramsey says. So anyways, that's my take. Overall, pretty good video, but I don't know if I really agree necessarily with Dave. I think real estate is a fantastic option for this couple, even though one of the people in the household, the income earners, are losing their income to go to school. So anyways, I hope you guys found that valuable. If you guys have any questions, as you can always message down below. Please, like I said before, please comment and subscribe. Turn that button blue. And until the next video, see you then.